Welcome to vTalkInsight, Market Drivers Daily for May 19th, 2026. AI spending is surging just as energy shocks and higher bond yields reshape the macro backdrop. The key question now is whether the AI Capex boom can keep powering earnings while geopolitics and central banks turn less friendly for risk assets. Let's begin with how the AI theme itself is evolving. AI is no longer just a promise on slide decks. It is already reshaping corporate balance sheets and labor markets. Massive capital commitments to data centers and chips, together with aggressive workforce shifts into AI roles, are pushing the theme from hype into execution. In recent days, we have described AI as being in the mid-phase of its cycle, and today's developments largely reinforce that narrative as a small group of AI leaders carries an outsized share of equity index performance. The scale of AI infrastructure buildout is striking. Announced data center capacity this year alone is around 100 gigawatts of power, roughly comparable to Germany's entire installed output. Google and Blackstone are planning up to $25 billion of AI-focused data center investment, with Blackstone committing about $5 billion of equity, underscoring confidence that demand will remain robust for years. Demand for AI compute is still running ahead of supply, with reports of usage doubling every few weeks and NVIDIA effectively able to sell all the high-end chips it can produce. This Capex wave is feeding directly into earnings leadership. Companies that have leaned hardest into AI are expected to show much stronger profit growth than peers, and some forecasts see NVIDIA delivering revenue growth north of 70% and profit growth closer to 80%, with free cash flow potentially rivaling the very largest incumbents. AI-related names now drive a large share of S&P 500 performance, while broader AI enthusiasm is fading at the margin, raising questions about concentration risk if this group ever stumbles. At the same time, AI-driven investment is contributing materially to growth, with AI Capex adding close to 1 percentage point to recent U.S. gross domestic product, and power and energy infrastructure providers emerging as important indirect beneficiaries. The counterpoint is that the bar for AI has risen sharply. Chipmaker stocks have already seen bouts of profit taking as rising long-term yields pressure valuations, and there is growing focus on whether heavy AI spending will translate into sustained cash flows rather than just higher costs. Examples include large tech firms whose data center budgets have ballooned from tens of billions to numbers that are an order of magnitude higher, as well as lofty private valuations where national security scrutiny is intensifying. Upcoming NVIDIA earnings, together with anticipated AI-related IPOs, such as a potential OpenAI listing, will be key tests of whether investor demand can keep absorbing new supply and whether earnings can justify current multiples. This powerful but narrow AI engine is the backdrop as we turn to a far less benign story in geopolitics and energy. Geopolitical risk in the Middle East has shifted from abstract tail risk toward a more concrete supply shock in energy markets. The Strait of Hormuz remains effectively closed, with U.S. Central Command redirecting dozens of commercial ships, and NATO even weighing naval escorts, signaling that Iran's leverage over a critical choke point may represent a new normal rather than a brief incident. Compared with late last week, when the focus was more on risk premia, today's conversation is increasingly about actual flows and how long-constrained shipping can coexist with stable growth. Oil markets reflect this tension. Brent crude is still trading above $110 despite a modest pullback after President Trump delayed strikes on Iran and suggested no attack was imminent, which briefly eased near-term risk premia. At the same time, the futures curve is steeply backwardated, spot prices sit well above the back end, and global inventories are being drawn down, with analysts warning that diesel and jet fuel stocks in Europe could hit dangerously low levels by month-end, and U.S. gasoline may tighten sharply by July. To contain price spikes, Washington has extended waivers on Russian and Iranian barrels already in transit, and is even exploring options such as gas tax relief, highlighting how limited the policy toolkit has become. This mix of constrained supply and policy improvisation is feeding directly into macro and cross-asset pricing. Each month of delay in normalizing Persian Gulf flows is estimated to add around $10 to year-end oil prices, and December Brent futures above $90 signal expectations of prolonged pressure. Higher fuel costs are already showing up in car data as double-digit increases in fuel and convenience spending, while elevated oil and gasoline threaten to erode household consumption and gross domestic product growth if sustained. Bond markets are reacting too, with rising yields partly reflecting inflation risk from energy and credit analysts flagging increased stress for sectors exposed to weaker consumer demand and higher funding costs. The counter-narrative is that there are still active diplomatic efforts. President Trump's decision to pause strikes at the request of Gulf allies and ongoing U.S. Gulf diplomacy have created a short window of reduced immediate risk, and some deals and sovereign wealth flows from the region remain resilient. However, there is little optimism about a rapid breakthrough with Iran, and analysts warn that each passing week of blockade raises the odds of more volatile price action as inventories run down. For markets, the key watch points are shipping conditions through Hormuz, any shift in sanction waivers, and whether consumer resilience can withstand another leg higher in energy costs. Those energy-driven inflation risks feed directly into the decisions now facing central banks. The rates backdrop is converging on a higher for longer regime as markets reassess central bank reaction functions in light of persistent inflation and the energy shock. U.S. Treasury yields have pushed to levels not seen since before the financial crisis, with the 10-year moving above 4.65% and a 30-year above 5.17%, and some forecasts pointing toward 5.5% on the long bond. Similar moves are evident across G7 curves, leaving global government bond yields at multi-decade highs and tightening financial conditions for households, corporates, and sovereigns. Recent upside surprises in inflation, including energy-driven components, mean price growth is running roughly 75 basis points above the Federal Reserve's target and is expected to firm further in coming months. Markets have responded by lifting the implied probability of at least one Fed hike by year-end to more than 60%, even as the committee remains divided and emphasizes data dependence rather than pre-committing to a path. In Europe, the European Central Bank is tightening policy into a slowing economy and elevated energy costs, while in Japan, stronger gross domestic product has pushed the probability of a Bank of Japan rate hike as soon as June towards 70%, with super long Japanese yields already at record highs. These yield levels are starting to bite. Interest rate-sensitive sectors, such as housing, are under clear pressure, with high mortgage rates suppressing turnover and dampening large home improvement spending, and persistently high UK yields weighing on housing affordability and mid-cap equities. On the corporate side, a looming $100 billion maturity wall in software loans and private credit for 2028 and 2029 is encouraging early refinancing at higher coupons, while rising long-term yields lift the cost of capital for big-ticket AI infrastructure projects. Yet high-yield tech issuance has remained surprisingly resilient thanks to shorter maturities and call features, and many AI-driven investments are seen as sufficiently high return that they can absorb somewhat higher borrowing costs. The counter-argument is that the adjustment in yields may be more drawn out than dramatic. Income-focused buyers are stepping in on spikes, which could slow the move higher and create a long transition toward a new equilibrium rate structure rather than a sudden break. At the same time, some areas of the economy, notably AI-related capital expenditure and corporate productivity gains, appear less exposed to higher rates than past cycles, reducing the risk that policy tightening fully derails the equity rally. Near-term catalysts include upcoming Federal Reserve minutes, key corporate earnings such as NVIDIA and Walmart, and the Bank of Japan's June decision, all of which will help clarify whether markets are overpricing or underpricing the risk of renewed hikes. Together with developments in the Gulf and the AI earnings season, these policy signals will be central to how cross-asset pricing evolves into the summer. To wrap up, the picture today is one of powerful but narrow AI-driven growth meeting a stubborn energy shock and a steadily tightening rate environment. The AI infrastructure buildout and looming IPOs are still supporting earnings and Capex, but leadership is concentrated and valuations are demanding. Geopolitical tensions around the Strait of Hormuz keep oil prices and inflation risks elevated, even as policymakers deploy waivers and contingency measures to buy time. And across the G7, bond markets are edging further toward a higher for longer regime, with central banks balancing sticky inflation against fragile growth. Watching how NVIDIA's results OpenAI's listing plans, Middle East shipping conditions, and upcoming central bank communications intersect will be critical for understanding whether current pricing in equities, credit, and rates can be sustained. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.